Yeah. Ouch. So what happened yesterday? Well, the Federal Open Market Committee decided to cut interest rates by 25 basis points. That was to be expected. In my previous video, I said that there's a 96% chance that they were going to drop interest rates by 25 basis points. Shouldn't that be good for companies? I mean, it means cheaper borrowing. It means cheaper borrowing for consumers, so you can spend more money. It stimulates the economy. It should boost stock prices. Or should it? Well, what was also released at the same time as the interest rate decision was the summary of economic projections, which differed significantly from the summary of economic projections that was released at the last FOMC meeting, which was in September. The summary of economic projections takes the Board of Governors' opinions, and the Board of Governors makes up the FOMC committee, who Jerome Powell is the head of. It takes their opinions of the economy and forecasts them into the future. And there's a few things that didn't look so great. Number one, everyone expected 4 cuts next year. For the 4 meetings that we were going to have 4 cuts. What was shown on the summary of economic projections is actually we may only get 3 or 2 cuts for next year. So while technically the Fed was dovish by cutting interest rates by 25 basis points, they were hawkish in their future outlook on interest rate cuts. They went from 4 to 3 or 2, which means they have a more hawkish stance going forward. This is not good for companies because it increases the costs of borrowing for companies, increases the costs of borrowing for the consumers. For projecting the costs of any stock, you discount any future cash flows it creates using current interest rates. And if interest rates are higher, it's going to be discounted to the point where stock prices are lower. This can hurt consumer sentiment, investor sentiment, and it can also hurt corporate earnings. In addition, if interest rates are going to remain higher, why would people want to invest in stocks when they can invest into safer assets like bonds, whose interest rates will remain more elevated than expected, or into high-yield savings accounts, whose interest rates will remain more elevated than expected because they are correlated with interest rates. So there's going to be more appetite towards going to these more conservative investments that are paying high yields than there is going to be towards the stock market that has more risk. So why did they have a more hawkish outlook for 2025? Well, it's because they projected that inflation is actually going to cool slower than they anticipated. If inflation is going to cool slower than they think, they want to keep interest rates a little bit higher in order to mitigate the stimulation of the economy and keep pressure on inflation so that it continues on its downward trend. Now, this is under the presumption that the labor market remains strong because high interest rates is not good for the labor market. It's not good for unemployment. If it's harder for companies to get cheap cash, they're going to have to basically, and this is simplified explanation, but lay off employees in order to, maintain the cash flows that they want. But Jerome Powell and the Federal Open Market Committee in general thinks that the labor market is resilient enough to withstand higher interest rates so that they can make more progress on inflation. So this came as a massive surprise to everybody because we all thought 4 interest rate cuts for sure, but now it's 3 or 2. So that's not good for companies because of the reasons I mentioned. So therefore, you see stock valuations drop dramatically. It was a surprise. That's what happens around binary events. When things are good and expected, things go stable. But if there's a sudden surprise, which no one anticipated, there's going to be a big market reaction. So while the Fed was technically dovish during the meeting because they cut interest rates by 25 basis points, they have a more hawkish outlook for 2025, and companies do not like that. You can see in their summary of economic projections when I compare September to the most recent one yesterday, that they expect inflation to come down more slowly, which is why they're more hawkish for this upcoming year. However, the good news is that Jerome Powell thinks that the economy is solid and that the labor market has cooled sufficiently. They want the labor market to cool so that there's not a bunch of economic activity that could stimulate inflation. So he thinks that the labor market has cooled slightly, sufficiently to not be a factor in stimulating inflation. In the press conference, which you can find a summary on my platform in the description below, he reiterated how strong he thinks the economy is, how strong he thinks the labor market is, and that it's softened slowly, but that he does not anticipate any sudden spikes. And so therefore, he can be more cautious going forward, lowering interest rates at a slower pace or a more intermittent pace to see how things play out and to make more progress on inflation. During the press conference, he did say that he feels like unemployment and inflation are kind of in balance. The focus on both of them are in balance. There's no need to cut rates in a hurry to stimulate the economy so that unemployment doesn't rise. And there's no reason to raise rates aggressively because inflation has a downward trend. But they do want to be a little bit more cautious and keep interest rates a little bit more restrictive so that they can make more progress on inflation. During that press conference, he did say that those two things are the dual mandate that their job is, which is to maintain stable prices and to maximize employment. He felt like they were in balance. And yet that's not really what the summary of economic projections says. And during the press conference, when people asked questions, he kind of gave some cues that, yes, inflation is coming down, but not as much as they would like. They're making progress, but to make more sufficient progress, they want to be more hawkish in the coming year. I will share the summary of economic projections for September and from the one yesterday in the description below, or maybe the pinned comment, so you can evaluate for yourself the differences between what they projected in September, which is a faster decrease in inflation, than they now project for the upcoming year and the years to come. Overall, Jerome Powell says that the economy is strong, resilient, the labor market is solid, and he thinks this is the way to go in order to keep it that way and to make progress on inflation. However, going from what was anticipated 4 interest rate cuts in this next year of 2025 to 3 or even possibly 2, looking at the median estimate of the Board of Governors, which makes up the FOMC committee, is not good for companies. So that's why you saw the stock market really take a pooper. I just wanted to make everyone aware that, yes, it looked like the Fed was dovish. And yes, Jerome Powell said the economy was solid. So why did the stock market tank? Well, it's because they're reducing their estimated interest rate cuts in 2025. And we don't know when the pause will be. Because if there's going to be 3 or 2, is there going to be a pause in January? Is there going to be a pause in whenever the next one is, March or whatever? When's the pause going to be? We don't know. There's a lot of uncertainty. However, I do want to reiterate that they believe that the economy is solid and that they do not think that unemployment is going to continue to rise significantly. They think it has softened. They want it to soften a little bit in order to not stimulate inflation. They want to keep making progress in inflation. So now with this massive dip, might not be a bad time to buy or dollar cost average. If you want one-on-one mentorship with me, you can join using the link in the description below. Otherwise, you can enjoy the free content I put out on YouTube. That's all I have to say about that. Thanks for watching. It's in the money. I love you guys, each and every one of you, in a special and unique way. Peace out.